All right, let's just dive right into it. Today, we're putting on our professional sell-side equity analyst hats for a highly rigorous, step-by-step fundamental explainer. Our target? Axcelis Technologies, ticker symbol ACLS. Now, if you follow the semiconductor equipment space, you already know these guys. But look, today we are throwing out the narratives. We're relying strictly on the cold, hard financial data from our source documents, applying standard valuation models, and trying to unearth the true intrinsic value of this business.
Okay, I want you to anchor your mind on this single number right here, $139.70. That's the last closing stock price for ACLS from our source materials. Honestly, the entire goal of this explainer is to figure out exactly what that number represents. Are we looking at a market that's priced in way too much optimism, meaning it's overvalued? Or is there some hidden margin of safety in here that makes this stock an absolute bargain? Let's find out.
Here is our playbook for today. We'll run through baseline financials, absolute valuation, alternative models, relative valuation, asset-based methods, and finally, our intrinsic value synthesis.
Let's start with Section 1, Baseline Financials, Growth versus Contraction. There is this incredible tension right out of the gate here. On one hand, Axcelis has compounded its free cash flow by a really healthy 11.42% annually over the last 5 years. Solid, right? But then, look at the right side. Over the trailing 12 months, that cash flow growth has just violently contracted by negative 16.81%. It's literally massive, historic, long-term growth crashing straight into a wall of severe near-term contraction.
So what are our foundational building blocks? Well, looking at the trailing 12-month metrics, they generated roughly $839 million in revenue. That converted to about $120 million in net income and $107 million in pure free cash flow. They're also pulling in a return on invested capital of 11.46%. Now, I want you to remember that $107 million free cash flow figure because it is absolutely going to drive our primary valuation test. Moving on to Section 2, Absolute Valuation, the discounted cash flow model. To run a DCF, we have to project cash flows into the future and then discount them back to today. As I mentioned, our starting line is that $107 million figure. But, as rigorous analysts, we've got to be totally transparent. Because our source data lacks specific discount rates, we actually have to declare an external assumption here. So we're applying a standard 9 to 10% cost of equity and a pretty conservative 2 to 3% terminal growth rate to run our explicit forecast.
And, wow, the sobering reality of this DCF output is pretty clear. Based purely on extrapolating that contracting free cash flow, the fair value price of Axcelis comes out to just $92.95. When you compare that to the current price of $139.70, we are staring down a deeply negative margin of safety at negative 50.29%. So judged purely by this cash flow metric, the stock is highly, highly overvalued.
Let's look at Section 3, Alternative Models, Methodical Elimination, and Residual Income. Look, good analysis isn't just about forcing data into a spreadsheet if it doesn't actually fit. We have to methodically eliminate models that don't apply. For example, the dividend discount model? Well, the source shows a 0% dividend CAGR. They don't pay a meaningful dividend, so we skip it. We look at the adjusted present value model to value debt tax shields, but their debt-to-equity ratio is a microscopic 0.04. The tax shield is negligible, skip it. And a sum of the parts valuation is out too, simply because the source doesn't break out separate business segment financials for us to analyze. But here's where it gets interesting. Because free cash flows are so volatile and currently dropping, the residual income model is actually a super robust alternative here. This model skips cash flow entirely. Instead, it values the company starting from its current book value and then adds the present value of future residual income. Basically, that's just the net income left over after you deduct a required charge for the cost of equity. To actually run this, we look at how efficiently they're using their equity. They generated $120.24 million in net income with a return on equity of 11.62%. Also, the market is currently pricing them at a price-to-book ratio of 4.15. By anchoring to the stability of the balance sheet rather than the chaos of a single year's contracting cash flow, this model gives us a much smoother, more grounded lens to view their long-term compounding ability. Next up, Section 4, Relative Valuation, Comparing to Peers. Now, full transparency here, another assumption alert. Our specific source documents don't actually list direct competitors.
So, to perform a relative valuation, we have to overtly declare an external assumption. We are building a proxy peer group based on general industry knowledge of semiconductor equipment makers. Think heavyweights like Applied Materials or Lam Research. We need this to understand what baseline multiples the broader market generally accepts for this sector.
It is absolutely crucial to look at Axcelis compared to its own 3-year track record. Look at this. Their priced-earnings ratio is currently 36.86, compared to a historical norm of just 19.01. That is almost a 94% premium. Their enterprise value to EBITDA is nearly double its historical average, and their price to free cash flow is trading at a massive 72% premium. Make no mistake, the market is demanding a really high price for this asset right now relative to its recent past.
Moving on to Section 5, Asset-Based Methods, NAV, and Liquidation Constraints. So the short-term liquidity here, it's honestly fortress-like. A current ratio of 4.77 means they could literally cover their short-term liabilities nearly 5 times over. But check out the EV to assets ratio, 2.95. The market's enterprise value is trading at nearly 3 times the value of the raw physical assets. What does that tell us? It indicates that pure net asset value or liquidation models drastically undervalue this company. The premium investors are paying is for the operations and the intellectual property, definitely not just the factories and the inventory. Finally, Section 6, Intrinsic Value Synthesis, the final pitch.
Okay, we're looking at the ultimate conflict when it comes to valuing Axcelis. On the pessimistic side, our recent cash flows give us a fair value of just $92.95. Sitting right in the middle is the market's current reality at $139.70. But then, on the optimistic side, actually modeled in this source data based on their historically high net income growth, we see an earnings per share fair value of $178.56. That is a massive valuation gap.
We're literally left holding 2 completely different stories. If you follow the free cash flow, you're looking at a highly dangerous negative 50% safety margin. It's flashing red, screaming overvalued. But if you follow the historical earnings compounding, you're seeing a really attractive 21% upside margin of safety.
So ultimately, as an analyst, as an investor, this is the giant puzzle you have to solve. We've laid out the strict financial reality using absolute, relative, and asset-based models. But it all boils down to this one question. When you look at Axcelis Technologies, do you trust the cold, hard, but contracting cash in the bank, or do you trust the historical compounding power of the earnings on the income statement? Which metric is telling the true story? That is the question you have to answer. Thanks for joining me on this explainer, and I'll catch you on the next deep dive.